Hi folks, this is Ariel Baruch. I am out of Sierra Cast TV studio in central New Jersey, and today our topic is home purchasing in New Jersey. And I want to look into the numbers, what goes into this and how does it work. Many people have questions, they don't understand, they're confused. There are a lot of numbers go into it. It's when people who look to get a loan, let's say $300,000 loan, $200,000 loan, which are very typical in the state of New Jersey. It's almost like a marriage. You almost like getting married to a loan officer or the company, because they can ask so many different things. They can ask for W-2s. If person work for a company, they're gonna ask for other types of income. They're gonna ask for liabilities. They're gonna check credit report. In fact, they're gonna do what they call tri-merge credit report. We're gonna take three credit reports from three major credit agencies, and then they will merge them into one report, which is called tri-merge report. They will ask for all kinds of papers, and essentially it will all revolve around one theme, and the theme is, can the borrower pay the loan? If it's a couple, for example, borrower and co-borrower, can the couple pay the loan? And it will all revolves around the credit ability of the people who like to borrow money, let's say $200,000, $300,000 loan. And it will also revolve around their debts and income. What is that debt to income ratio? So those two key factors that will that will help the bank make a decision. Can they lend the money? Usually, many banks have their own programs. They have some their own portfolio loans, but they also may broker out loan to somebody else if they cannot underwrite it. But at least they can find somebody else who can underwrite the loan. But in many cases, it's a lot of paperwork, a lot of goes into it. And today I just want to walk you through some of the numbers, some of the typical numbers you can see. And I chose three examples. And in this specific video, we look at home purchasing in New Jersey. So let's go after the numbers. So on a screen, you should see right now the numbers you see on the screen. I actually copied from a proprietary software we use in Compass. And I did that so to preserve the privacy of the specific person who did this loan. But these are real numbers. This is it. This is what actually happened with the property that was purchased in South Jersey. It was in May 2020, and so the purchase price was $195,000. I'm gonna go through the numbers and just to give you an idea what goes into it, and I'll make some comments. Something that you should be aware of when you applying for a loan and when you look shopping around and looking for better interest rate and what other terms go into this whole process, because a lot of people just don't get it. They don't understand. It's quite involved. A lot of people work on these applications. There is the person who faces the borrower is typically a loan officer, a loan originator, but then there is a loan processor, and then there is in some companies there's a loan opener, and then there is, of course, there is underwriting department where underwriter actually make pretty much a decision. Can we lend this person money, or we cannot lend the person the money? So there are a number of people, and that's just before loan gets issued. After loan gets issued, there are other people at the company who look into the loan and make sure all the compliance and everything that's supposed to be correct is there. Okay, so let's look through the numbers. $195,000 loan. The down payment, person decided to pay 3.5%. This specifically was a FHA loan. So you're gonna see the FHA is a Federal Housing Administration. It's those loans are usually good for people who have slightly lower credit scores and they don't have enough. They don't have much money saved for the down payment. So for them, it may be more beneficial. But really, it really becomes very helpful for people who have lower credit scores. Let's say we're talking about 650, 660, 670 middle credit score. For those people, usually they may get much better mortgage insurance rates than if they would go with some other types of loans. So in this specific case, this was a FHA loan, and was the best option for that specific borrower. It was a 30-year loan. The property taxes for that specific property was roughly $7,800. The property insurance roughly $1,300. The interest rate that borrower was able to get is roughly 3.3 and that what affected that interest rate is the credit score of the borrower. There was a married couple, but the actual borrower was the wife, so essentially she bought property in her name. Fee to obtain the reduced interest rate, that it was 1.8%, and that was because the person had a lower credit score and they also wanted to put less money down. So there are a number of factors that go into this, but in this specific case, the borrower also wanted to put less money down, so some of the costs were actually rolled into the loan. So this is where this fee come from, roughly 1.8%. And then because it's a FHA loan, it had two types of mortgage insurance. There is upfront mortgage insurance. In this case, it was 1.75%. And then there's a monthly mortgage insurance, is 0.85%. So the reason why FHA does it this way, by charging upfront mortgage insurance and monthly mortgage insurance, is because this helps reduce the down payments upfront, but at the same time, over a longer period of time, this loan costs a little bit more to the borrower, but it helps people who don't have much money saved get foot in the door, buy a property. So, and many times what happens is that people who have low credit scores, they don't have much money saved, or maybe they went through some financial troubles and they just want to get back, buy a property for themselves. So those people typically would get FHA loan, but then later on they will refinance it. Let's say a year or 2 years from the point of purchase, they will be able to improve their credit score, pay down some debt, build up their credit simply by paying large mortgage payments. People can significantly, I would say even sometimes dramatically, increase their credit score, and then that in turn will allow them to actually refinance it later on with a different program that perhaps will not have the mortgage insurance, or will have a better, more beneficial financial terms. So let's go down. So the down payment, 3.5%, is roughly $6,800. The purchase price is a difference between the purchase price less down payment, $188,000 roughly. And we have upfront mortgage insurance payment, total loan amount, breakdown of monthly payments. So there's a principal, there's insurance, taxes, and insurance, and the total monthly payment is $1,700. Total charges for rate chosen. So there is a fee to obtain a reduced rate. Like I said, part of that fee is because person wanted to roll some of the costs into the loan. So this is where this fee come from. Origination charges. So typically the bank will charge, there's application fee, commitment, in this specific case was application fee and commitment fee, roughly $1,500. It may not be immediately obvious, but there's a lot of hours go into putting a loan together. So like I said, there is a loan originator who works directly with the borrower, but then there is a loan processor, there is an underwriter, and there are a bunch of other people who make sure that compliance has been followed and everything is exactly the way it's supposed to be. So there is actually quite a lot of work goes into this. So this is where this fee come from. There is always, many times there's appraisal fee, not always, but if somebody buy a property they don't own, almost always person will have appraisal fee. Most companies will charge it. So it's in this case $525. It depends on appraisal company, but that's for New Jersey. That's about where this is about how much people will be paying. There's a title review. There was a title review fee, and then the services borrower can shop for, and this is important. So there's a title. Typically, there is either the attorney or the title company who will close the loan, and in this specific case the borrower chose to work with the title company. In this specific case, the title company was actually out of state, and that created some issues because the title company was not familiar with the New Jersey market, so it took a little bit longer to close. It just added a few more days to get through all the paperwork and close the loan. So that's one thing I do recommend, is that really work with a reputable title company. Ask for recommendations. Ask the mortgage company or bank you work with for recommendations to which title company they can recommend. But this is one thing that the borrower can choose. The borrower can shop around and choose which title company serves better their needs. Some people willing to pay a little bit more money, but if they know the company, if they trust the company. So that's my recommendation. Definitely go with a reputable company. Don't just try to save a couple bucks and choose some unknown title company out of state. it can backfire, and in this specific case, it did backfire, and the person ended up closing the loan, but it took like 4 or 5 days longer to close the loan because there was some issues that had to be resolved with the title company. So in this specific case, there was a closing protection letter fee, $75. There was some endorsement fees, title insurance. So the way title companies work is that they essentially insure the mortgage, and it goes both ways. So they will insure lender's title insurance policy, but then the borrower can also have insurance policy. Borrower insurance policy will be significantly less than the lender because lender is really putting up the money. For example, in this case, almost 200,000. So to insure this amount of money, the title company issued the insurance policy, and it was roughly 1,100 in this case. So there are some other fees. So the settlement fee, title company typically will charge. There's tax search fee. In this case, they were roughly 300 each. Government fees, there was a recording fee, deed recording fee, there's a mortgage recording fee. So those were the other fees. And then there are prepaids, things that paid in advance. So what happens is that when the lender lends the money, there are two things. There are prepaids and there are reserves. So reserves are meant to be kind of provide the cushion just in case something is not quite right, or maybe the bank thought that the taxes for the property is 7,000, but in fact it's maybe 7,500. So let's say slightly higher. So the reserves will serve essentially as a cushion. But then there is also a thing like a prepaid, where, for example, home insurance, typically, especially in New Jersey, home insurance has to be paid in advance for the next 12 months. So that's one fee, and then there are some other fees, for example, taxes. So there may be school tax that has to be paid in advance. In Pennsylvania, it's common. In New Jersey, it works slightly different. In New Jersey, it's more over on a quarterly basis. And then other things is that, for example, if loan is closed during sometime within a month, there may be a certain number of days that needs to be factored in, and in this specific case, the loan was closed 3 days before the end of the month. So this is why you see here. There was a prepaid interest for 3 days that the borrower had to pay. So for reserves, there's a property insurance, 3 months. Person had to pay the township taxes. Township property taxes, a borrower had to pay for 2 months, and then county taxes. There were no county taxes, I'm sorry. And the other fees, so there was owner's title insurance was $38. This is optional, but it is recommended. It essentially protects the money that the borrower put down as a down payment. For example, typically when somebody buy a property, there is a down payment, borrower puts some money as a down payment, but then there is a lender who put the bulk of the money. So the lender's title insurance property protects the lender. The money that the borrower put up front really protects the borrower. So in this case, this is $38. There's a broker fee. Typically, a realtor will have some kind of a fee. The realtor's office will have a fee, and then the realtor will charge a fee, but the realtor will charge a fee to the seller, at least in New Jersey. And there may be some other adjustments based on the situation with taxes. If the seller prepaid the taxes and then it has to be refunded back to the seller on a closing date, this is what will happen. Okay, so in this specific case, the total costs to close this loan was roughly almost $20,000. Again, it incorporated closing costs plus some other fees, like for example, borrower wanted to incorporate some of those closing costs into the loan, and then the seller agreed to provide a seller's concession. So in this case, it was $9,300. So closing costs minus seller's concession minus some other things that the borrower paid ahead of closing date. So it was appraisal fee, $525. There was a earnest money deposit, was $2,000, and there was some tax credit from seller, $110. So overall, before closing date, the borrower essentially paid $26.35. the seller agreed to contribute to pay for the closing cost $9,300. So the end result, the cash from borrower at closing, was roughly $8,000. So you can see here, I mean, it may sound like it's really difficult and expensive to buy a house, but this specific borrower used FHA program. She essentially provided a check for $8,000 and she got the home. So I think it's a good deal, especially for people who maybe first-time home buyers. They didn't save enough money, or maybe they just don't have they don't have a lot of money. They may have some issues with the credit. Maybe their credit score is not that great. You know, let's say 650, 660, 670. So in those situations, this is a great program. They should definitely look into FHA program. So I hope you found this useful. If you feel that you want to learn more about this subject, how it works, feel free to reach out to me. You can just send me a text message or call. My phone number is 609-222-1222. I'm affiliated with the Contour Mortgage out of Robbinsville, New Jersey. This is in central New Jersey. You can either search our office through Google Maps. Again, it's a Contour Mortgage out of Robbinsville, or you can call me 609-222-1222 and reach out with questions. If you have any questions, concern, or if you need help analyzing your specific situation, we'll be more than happy to help you. Feel free to comment below on SierraCast and let us know what other topics and subjects you're interested in, and we'll be more than happy to research for you and make another video. Thank you. Have a good day.
Awesome.